So, you're tuning in right now hoping to find out whether Bank OZK beat or missed analyst consensus for the second quarter or, what their forward guidance looks like.
Yeah, or how the stock reacted in after-hours trading.
Right, exactly. If you want that, you're going to have to look elsewhere today.
We have to completely block out the noise.
We really do. As strict fundamental analysts for this deep dive, our single mission is parsing the actual printed numbers from their Q2 2026 earnings release. No Wall Street speculation. We are sticking exclusively to the hard data.
Which is honestly the best way to find the real operational signal anyway, rather than just reacting to algorithms.
I agree completely. So let's just fire off the raw headline data straight from their July 21st publication. We are looking at a Q2 earnings per share of $1.49. And net income is sitting at $163.3 million.
Yeah, I mean, $163.3 million in pure profit over just 3 months. That is a massive number on its face.
It is.
Yeah.
But if you look at the trajectory, things get, well, kind of complicated for you as a retail investor trying to make sense of this bank's health.
Oh, definitely. The time frame you choose to focus on changes the entire narrative here.
Right. So that $163.3 million in net income, it's actually down 8.7% year over year. Like in Q2 of 2025, they were sitting at $178.9 million.
Yeah, a nearly 9% drop in net income is, I mean, you can't ignore that. It's a noticeable contraction.
For sure. But here's where this story gets a bit mixed. If we just look at the immediate sequential time frame, so just the last 3 months compared to the 3 months immediately before that, that $163.3 million is actually up 2.5% quarter over quarter.
Because they posted, what, $159.3 million in Q1 of this year?
Exactly. And we see that exact same mirror dynamic when we look at the EPS. That $1.49 per share is down 5.7% from last year's Q2, but it's up 3.5% from Q1 of 2026.
It's just a textbook divergence between a long-term trend and short-term momentum.
Right.
And, to give you the full macro view, if we zoom out and look at the first 6 months of 2026 in totality, the bank generated $322.6 million in net income.
Which is a 7% decrease compared to the first half of 2025, right?
Yes. And the 6-month EPS sits at $2.93, which is a 3.9% decrease from that same period last year. So the year-over-year drag is undeniable. It's persistent across the entire first half of the year.
I look at these numbers and honestly, it reminds me of looking at a competitive runner's split times during a marathon.
Okay, I see where you're going with this.
Like you look at the overall stopwatch, and they're running slower than their personal best from this exact same race last year, right? They are objectively off their peak pace.
Right, the year-over-year slump.
Yeah. But if you look at their splits from just the last mile compared to the mile right before it, they actually accelerated. They are picking up speed in the immediate term.
Yeah, that's a really good way to frame it.
So what does this all mean for a retail investor trying to gauge the actual health of the business? Like, which metric tells us the truth? The year-over-year slump or the quarter-over-quarter acceleration?
Well, the tricky part is they both tell the truth, but they are answering completely different questions about the bank's operating environment.
How so?
So the year-over-year drag reflects the broader systemic headwinds that the entire banking sector has been navigating. I mean, the earnings release doesn't dive deep into macroeconomic theory, but that contraction tells you the cost of doing business has fundamentally shifted since 2025.
Basically, acquiring and keeping deposits got way more expensive.
Exactly. The environment got significantly harder. But that quarter-over-quarter growth, that is the vital signal for stabilization.
Ah, okay.
It tells us that management has absorbed the initial shock of those year-long headwinds, and they're beginning to find a new equilibrium. A sequential increase in net income suggests that the bleeding relative to last year might have bottomed out in Q1.
So they took the hit, they adjusted their strategy, and now they are climbing back up.
Precisely. They're optimizing within a tougher environment.
But, a recovery doesn't just happen by magic. If the top-line macro conditions are still tough out there, how are they actually squeezing out that sequential net income growth?
Right, you have to look under the hood.
Yeah, are they just ruthlessly cutting costs, or is a core business performing better? Let's transition into the operational metrics because CEO George Gleason highlighted some very specific figures in this release.
He framed them as, quote, solid financial results.
Right. He pointed to a 1.60% return on assets, a 4.24% net interest margin, and an efficiency ratio of 39.2%.
And those are heavy-hitting numbers for any regional bank, but they require some unpacking to really understand what's mechanically happening here.
Well, let me push back on one of them right away. because that efficiency ratio of 39.2% jumps off the page, to me as a potential red flag, not necessarily a point of pride.
Interesting. Why a red flag?
So for anyone unfamiliar, the efficiency ratio is basically how much a bank spends to make a dollar. A 39.2% ratio means they're only spending about 39 cents in overhead to generate every dollar of revenue.
Which is incredibly low. I mean, most regional banks are thrilled to be operating in the low to mid 50s.
Sure, but think about what that means mechanically. Are they like a Formula One car that has already stripped out the air conditioning, the passenger seat, the radio, just to drop weight?
I see what you're saying.
If your efficiency ratio is already down to 39.2 and your net income is still down 8.7% year over year, does this suggest they've hit a wall? Have they squeezed every possible drop out of the expense management side?
You're asking if they've run out of room to cut costs.
Exactly. My concern is that they are hitting a ceiling where they simply must find massive top-line growth because they can't get the operation any leaner without cutting into the actual muscle of the bank.
That is a totally valid concern. When you're operating in the sub-40s for an efficiency ratio, you have virtually exhausted the cost-cutting lever. You really cannot cost-cut your way to sustain future growth from a baseline of 39.2%.
There's just no more fat to trim.
Exactly. However, you have to look at that efficiency ratio in tandem with the other two metrics Gleason highlighted, the return on assets and the net interest margin.
Because those show us the actual engine, not just the weight of the car.
Right. Let's start with return on assets, or ROA. This isn't just a fancy percentage for a slide deck. Think of the bank's assets, like its loans, its cash reserves, its investments, as factory machines.
Okay.
An ROA of 1.60% tells us exactly how many cents of pure profit each dollar of those assets is spitting out over the year. And for a regional bank, anything over 1% means those machines are running hot.
Wow. Okay, so at 1.60%, they are highly effective at utilizing their balance sheet.
Very much so.
And what about the net interest margin? They reported a 4.24% NIM.
The net interest margin is arguably the most critical vital sign of a bank's core utility. It measures the fundamental spread between what the bank is paying out to borrow money, like the interest they pay you for keeping your checking account there, and what they're earning on the money they lend out.
Like for mortgages or commercial real estate.
Exactly. And a 4.24% NIM is exceptionally robust. It shows that despite those macroeconomic pressures we talked about, they are maintaining a massive spread.
So even if they are maxed out on efficiency and can't cut more costs, the core business of taking in deposits and making loans is just highly lucrative for them right now.
Yeah, it acts as a massive layer of insulation. It's the reason why, even with a 7% year-over-year drop in six-month net income, they can still post $163.3 million in a single quarter.
The engine itself is just running incredibly efficiently.
Right.
So they aren't scraping by, they're just making slightly less of a huge pile of money than they did last year.
Pretty much.
But, you know, high margins can be a mirage. You can have a beautiful 4% spread today, but if the loans generating that interest suddenly go bad tomorrow, that entire margin just evaporates overnight.
Absolutely. Credit quality is everything.
Right. A great engine doesn't matter if the chassis falls apart. So we really have to look at the foundation here. What exactly is sitting on their balance sheet to support these numbers?
Well, the earnings release goes out of its way to address their balance sheet strength. Management highlights strong increases in both book value and tangible book value per common share.
Let me pause you there for a second. What's value makes sense to me? It's just assets minus liabilities. But why specifically highlight tangible book value?
Well, tangible book value is basically the ultimate worst-case scenario metric.
Like a liquidation scenario.
Exactly. It strips away all the intangible assets, things like goodwill from past acquisitions or brand value. It looks purely at the hard assets.
Okay, so just the cold, hard cash and physical assets.
Right. It asks the question, if we had to liquidate this bank today, what is the actual physical value left over for the shareholders? So a strong increase in tangible book value is management signaling to the market that their underlying assets are fundamentally sound.
They aren't just propped up by accounting goodwill.
Exactly. They also point to meaningful increases in their capital ratios, which is essentially the cushion of equity they hold to absorb any potential losses.
And they really need a big cushion because we're not talking about some small community credit union here. We need to talk about the sheer scale of this operation.
Yeah, the size is significant.
As of June 30th, 2026, Bank OZK is sitting on $41.7 billion in total assets.
That is a formidable footprint. That level of assets moves them way out of the traditional community bank tier and into a much more complex operational category.
And that complexity is really reflected in where those assets are physically located.
Yeah.
The release states they're operating across 267 offices.
Spread across 9 different states.
Yeah. Well, let me actually read this footprint because I think it is the most revealing part of the entire document. They are in Arkansas, Georgia, Florida, Texas, North Carolina, Tennessee, New York, California, and Mississippi.
That is a very specific and very wide geographic spread.
Right. I mean, they're a regional bank that was born in Arkansas, but they have planted their flag in heavy hitter, high GDP states like New York, California, and Texas.
The big economic engines, yeah.
Which brings me to a question about their strategy. CEO George Gleason specifically touted their, quote, strategic diversification of our loan portfolio. But normally we think of regional banks as being local experts. Isn't it a lot riskier for a bank based in Arkansas to be underwriting loans in Manhattan and Los Angeles? Like, don't you lose your local edge when you spread out that far?
You might think so intuitively, but in the modern landscape of regional banking, it's actually the opposite. Geography is destiny.
How do you mean?
Think about it. If your entire loan book is concentrated in a single metropolitan area, say just Little Rock, Arkansas, you are entirely beholden to the microeconomy of that specific region.
Right, so if a major local employer goes bankrupt
Mhm.
or real estate values in that one zip code plummet.
Your entire bank is threatened because all your eggs are in one economic basket. And that is precisely the opposite of what you want when you are managing $41.7 billion.
So they have to spread out.
Yes. By spreading across 9 highly distinct economic zones, from the tech centers of California to the financial hubs of New York, down through the rapid growth corridors of Texas and Florida, they are engaging in a form of geographic arbitrage.
They're intentionally uncorrelating their risk. Okay, so this is the actual physical mechanism behind the strategic diversification Gleason is talking about. It's basically a localized recession shield.
That's a great way to put it.
You make sure that a localized real estate slump in Mississippi doesn't sink the entire ship because you are still generating those high-margin returns in Florida or North Carolina.
Yes. They are building massive shock absorbers into the balance sheet. And frankly, we see the necessity of those shock absorbers when we look at the forward-looking statements section of the release.
Ah, the section that usually reads like endless legal boilerplate.
It is boilerplate, but it is highly relevant boilerplate. The release explicitly notes that their future expectations are subject to known and unknown risks, uncertainties, and assumptions that are difficult to predict.
Basically the standard, don't sue us if the national economy tanks, disclaimer.
Exactly. They openly acknowledge that future economic conditions, interest rate fluctuations, and inflation are completely beyond their control.
But it frames how we should view their whole geographic strategy.
Yes, look at how management counterbalances that admission of unknown risk. Gleason states that their solid financial performance and steady progress on initiatives have them well-positioned for the future.
So that strategic diversification we just talked about is their stated method for staying well-positioned.
Right. They know they cannot control the Federal Reserve and they cannot control a national recession, but they can control their exposure.
By diversifying the loan portfolio across 267 offices.
Exactly. By being in 9 disparate states, they are mathematically reducing the likelihood that any single unknown risk in one specific market can critically wound their $41.7 billion balance sheet.
So the geographic footprint isn't just about chasing new customers. It is the active defense mechanism protecting that massive 4.24% net interest margin we talked about earlier.
It all connects back to the engine. If the loans are secure because they are spread out, the margin stays intact and the engine keeps running hot.
That is the narrative management is clearly presenting in this data. They are building a fortress out of geographic diversity.
That's exactly what they want the market to take away from this.
Okay, let's bring this all together and distill the actual operational signal we've extracted today.
I'd say the raw data paints a picture of a bank in transition, but one that is highly controlled.
Right. We have Bank OZK currently navigating a year-over-year earnings dip with their 6-month net income down 7% from 2025. The systemic headwinds are clearly real.
Very real.
However, they are showing clear quarter-over-quarter momentum, up 2.5% in net income sequentially, which proves that the operation is finding its footing and stabilizing.
And they are achieving this through an incredibly lean operation.
Right, marked by that somewhat concerning 39.2% efficiency ratio, but propped up by a very strong 4.24% net interest margin.
And to protect those margins and their massive asset base, they are heavily leaning into that strategic diversification.
Expanding far beyond their Arkansas roots across a 9-state footprint.
It really is a textbook execution of finding yield in powerhouse economies while attempting to mitigate regional concentration risk at the exact same time.
Which leaves us with one final, pretty provocative question for you to mull over based on how management framed their position. They insist that their solid performance and aggressive diversification have them, in their words, well positioned for the future.
Which is a statement of extreme confidence in a very unpredictable environment.
Right. Which brings us back to the Formula One car analogy. Considering those standard warnings about economic forces totally beyond their control, you have to ask yourself about the true motive behind this 9-state geographic spread.
Is it offense or is it defense?
Exactly. Is this aggressive loan diversification a tool being used to actively chase future top-line growth because their efficiency ratio is maxed out and they have no other way to grow? Or is it purely a defensive shield, a fortress meant solely to protect their current high margins from localized regional economic downturns?
Are they playing offense to find new revenue or playing defense to protect what they have?
Right. It is the multi-billion-dollar question for anyone analyzing regional bank strategy right now. The numbers in this July release show us the what and the how, but the long-term why is something that will only be revealed in the quarters to come.
And it is definitely a metric you will have to keep a close eye on as they navigate the rest of 2026.
Absolutely. Well, if you found this strict data-only breakdown valuable, make sure to follow the show for our daily earnings coverage, where we cut through the noise, ignore the speculation, and get straight to the numbers that actually matter.